So good morning, everyone, and I do hope everyone is well. And we previously talked about the income statement, the balance sheet, and the statement of retained earnings. And the last statement I want to talk about in Chapter 3 is the statement of cash flows. Okay, and this is just this has got three components. Let me just say that first: three components, and it's a summary of all the cash flows over the period. And this is one of the most important statements you could ever want to see, because think about it from a personal level. If you have a balance sheet and you have a lot of assets, but you don't have cash and you can't buy food, you got a problem, right? So cash is king, as they say. Okay. So I just want to, right off the bat, I want to just say a couple things here. Okay, if you look at table 3-4, there's three components, and they're in bold text. Cash flow from operating activities. Okay, so we'll highlight that, right? Cash flow from investment activities, and we'll go over each of these in a minute. All right, so let me just highlight them. And cash flow from financing activities. All right, so I think I have a little note here. Let's see. No. All right. Anyway. So cash flow from operating activities is the money you bring in from the company. Everyone see that? This is a lot of these are off the income statement. Net profit after taxes, depreciation, increase in accounts receivable, decrease in inventories. This is off of the balance sheet, right? Accounts payable, balance sheet, accruals, right? Balance sheet. So this is the money actually made from within the company selling your product. Okay. This is the money you made on your investments in the company. All right. So maybe you increased your gross fixed assets. You know, you bought physical big things, and you changed the shares you own. Maybe you invested in other companies. Okay, and you know, maybe you brought in cash from other investment activities you've done. And then the third one here is cash flow from financing, and this is how you're bringing in money from selling stocks and bonds. Everyone see that? From financing activity, here's the debt, the bonds, and here's the equity, right? And then you're shelling out the dividends, so that's some of the cash disappeared. You had to pay dividends to the shareholders, correct? All right, so I just want to make those points clear. So you have those three things. So basically, here's the operating total. Here is the investment total, which is negative in this case. And here is the financing. And when you add up all three, you notice you're a positive 92,000 in this case. All right. So you're a positive 92,000. So that's pretty much it with regard to the statement of cash flows. This is a simplified version, and it's very simple. I sent you that Merrill Lynch document, and I hope you had a chance to look that over. That's got a lot of great details in it on statements, how to read a financial report. All right, so basically, there's a lot of notes that are attached to the financial statements, and basically they're explanatory notes with relevant accounts. They provide detailed information on the accounting policies, procedures, calculations, and transactions. Okay. So so that's basically it with that. So, and they're worth reading, right? And this because of Sarbanes-Oxley, you had to comply with the law. They're a lot more tedious now. All right, so we move on, and now we talk about financial ratios. And this is called ratio analysis. And what we're going to use is the key values that appear on this financial statements and create ratios to see what these ratios tell us about the health of the company. We're looking at the health of the company, all right? So again, you can see what it says there. We're going to analyze and monitor the firm's performance, okay? So most of these come off the income and balance sheet, as you can see here. So let's highlight that, all right? So most of these come off the income and balance sheet. So there's a lot of people who worry about the financial statements, and I'm one of them, right? I'm a shareholder, and the creditors who loan the company money, and like banks. So you can see management, like stock. I guess I'm considered management, right? Like stockholders, focuses on all aspects of the firm's financial situation, and it uses ratios to monitor performance from period to period. So we're going to look at a couple different ways that ratios are used, okay, for comparison, okay. Now, first of all, you got to understand, you don't just calculate the ratio and say, okay, I'm done. All that is a number, right? Like, well, what does that mean? It's a number. Does it have any relevance or significance? Basically, it's the interpretation of the ratio value that's important, okay? So looking at the ratios over time will give you an idea, the trend of how the company has been doing over time or how it hasn't been doing over time. So you can make, a better judgment about the company's performance. So the first thing we're going to look at is called cross-sectional analysis. And cross-sectional analysis involves the comparison of different firms' financial ratios at the same point in time. So we should highlight that, right? That's an important statement here. How about make that pink? Analysts are often interested in how well a firm has performed in relation to other firms in its industry. Frequently, a firm will compare its ratio values with those of a key competitor, a group of competitors, or even top-performing firms from other industries that it wishes to emulate. And this is, again, there's another word for this called benchmarking, all right? We're benchmarking against another company. A type of cross-sectional analysis in which the firm's ratio values are compared with those of a key competitor or with a group of competitors that it wishes to emulate, okay? All right, one simple type of benchmarking compares a particular company's financial ratios to the industry averages as a whole. And there's a lot of sources that publish industry average ratios, okay? So we should highlight these here, right? Dun & Bradstreet's norms and keys. And you can see there's a lot of different companies that will publish industry averages so you can compare your company against them. So here's financial ratios for different companies, right? Apple, Hewlett-Packard, right? And you can see the industry average in bold here. So here's Apple and Hewlett-Packard, and we're going to go over these different ratios. And here's their different ratios. And here is the computer industry as a whole, right? This is the computer industry as a whole. So we'll highlight that. And here's Home Depot and Lowe's, and then here's building materials as a whole. So we're going to compare them, Home Depot and Lowe's against that. And then here's Kroger and Whole Food Markets. And then we'll look at grocery stores ratios as a whole. All right, Target and Walmart, and they call those the industry that's in a merchandise store. Okay, so that's a merchandise store. So you can see how that's done. So analysts have to exercise great care when drawing conclusions from ratio comparisons, okay? So, you're comparing yourself to your peers. So the important point here is what? That ratio analysis on its own is probably most useful in highlighting areas for further investigation to see if things are not going well. All right, and here's an example that you can go over, a nice example. And they look at the inventory turnover, how often Caldwell is turning over its inventory compared to the industry. And you can see the fact that they're turning over their industry a lot further, much faster and more often means that they're doing well, right? So there are times when inventory turnover doesn't reflect everything, right? You can see it says the turnover was 53% faster than the industry average. On reflection, however, she realized that a very high inventory turnover could be a sign that the firm is not holding enough inventories, and that means it's going out and having to constantly picking up inventories and having delivery charges. So you got to look at these very carefully, okay? All right, let's look at this video and see how this all goes here.
Financial ratios are very useful in evaluating a firm's performance along a number of different dimensions. Ratios help us to determine how profitable a firm is, how efficiently it is managed, and even how risky the firm might be. But with most ratios, there is no single optimal value that a firm should strive for. For example,
All right, I'm stopping that video.
It might seem obvious that a firm.
All right, there's a problem with the audio on here, so I'm going to stop that. All right, and all right, the other way of doing it is with time series analysis. And time series analysis is going to evaluate your performance of just your company over time, all by itself, standalone. So a comparison of current to past performance using ratios enables analysts to assess the firm's progress and to spot, and this is the important word here, let's spot trends. Everyone see that? So the ability to spot trends. Any significant year-to-year changes may indicate a problem, especially if the same trend is not an industry-wide phenomenon. All right, so I'm about 14 minutes in, and I'll make a part 4, and we'll do up the combined analysis. Okay. So you should be able to play this watch this little video at home. Okay. I don't know. I'm having trouble running it this morning.